Hello, everyone. Thanks so much for tuning in. I'm happy to be here, and thank you to Dr. Leaf for inviting me to chat today. My name is JJ Wenrich. I'm a certified financial planner professional, and I'm author of the book, Teaching Kids to Buy Stocks, Stories and Lessons for Grown-Ups. I'm very much looking forward to talking to you today about the ABCs of buying stocks. I've been into the stock market. I've been an investment professional since I graduated from the University of Kansas in the year 2000. And I actually got into the stock market and interested in it when I was quite young. I had a seventh grade teacher in the small farm town that I grew up in Kansas that enrolled us in a stock market contest and had an investment professional come out and speak to us about the basics of the market. And my goal is to just simplify what can be a quite complex topic into language that anybody can understand. Folks that are in the investment business or in the finance world, and a lot of the books that are written for finance, they speak at a level or two above the language that most of us speak in, and so they do that through no fault of their own. It's just how they talk. They can't even tell they're doing it. And so my goal with my book and with today is to speak in terms anybody can understand and bring it down to a level that hopefully helps everybody in the audience, no matter where you are in your investment path. If you're a beginner, if you've already been investing for some time, no problem. I think that I'll have some good information for you. I've prepared some slides, so lucky you, you don't have to just stare at me the whole time. You'll actually get to go through the slides that I put together, and I'll share my screen right now so that we can get into that. Maybe, bear with me. Well, bear with me a minute. It worked in the practice run, having a little problem now. Go. There we go. Hopefully you see my slides. Do they see my slides, Cody? Let's see. So hopefully you can see this. I'm not able to get any feedback that that you can't. We would love to connect with you beyond just today's presentation. Sorry for the little technical glitch there. Hopefully, hopefully you can see the right thing. There we go. So again, we'd love to connect you beyond today. We certainly try to make it easy. By we, I'm referring to my amazing wife of 18 years, Jody, who works hard behind the scenes to help manage all of what we do. You can find either one of us. Her name's Jody with an IE. I'm JJ Wenrich. We're both on LinkedIn. That's actually how we met Dr. Leaf. So you can find us there. But in addition, we have active social media streams dedicated to the book on LinkedIn, on Instagram, Twitter, Facebook, and we love to share stories, lessons, different things that we come across, things that we've created ourselves. But we try to do so while keeping things light and entertaining. On the screen? So, That didn't work. I apologize. I am new to using this service. This is not what I'm familiar with. So let me try again. Here we go. I think I have it. No? You see me freaking out.
Sorry, I couldn't quite hear you. Could you?
Okay. So I may have to go slide free because having the technical difficulties with this. I do apologize. Hey, we do have it. Okay. My goodness, folks, I'm so sorry. I'm just not familiar with this platform and wasn't sure how it was going to go. So I do apologize. So there you can see our handles for Instagram, Twitter, Facebook, LinkedIn. So the other thing I've put up there is my email address and my telephone number. So feel free to reach out. We definitely want to be as helpful as we possibly can be. Feel free to ask questions, start a conversation. You can shoot us a text, leave a voicemail, and we promise to get back to you. Here's what we're going to talk about today. A little bit of an agenda. First things first, I'll cover some things you need to think about and learn before you get started. We'll talk about the basics of stocks as you might expect, a tiny bit on bonds, and then we'll go into the topic. When I talk about picking stocks, talk about finding a story that you can understand, a story that you feel like you want to be an owner of. I'll talk about some of the numbers that you should focus on. And then with stocks, it's all about expectations. You know, what are the expectations for that story? What are the expectations for those numbers to do over time? We'll go into how to open accounts and just some things to think about when it comes to actually buying stocks in an account, and talk about a little bit about retirement plans and why that might be what how most folks invest for the first time. Talk a little bit about how those work and how they might apply to if you decide to buy stocks. And then briefly, I'll talk about talking to your kids. That was really the heart of the book, is to help you teach yourself, but also, even if you don't feel like you're qualified to talk to your kids about it, show you that it's really quite simple to bring these concepts down to a level that anyone can understand and make them part of your conversation with your kids. So with that, let's dig in. First things first, before we can really dig into the ABCs of buying stocks and talking about the stock market, we need to take care of some critical business. Maybe you've already done some of these things in your life, but for those that haven't, well, we need to cover them. So before you dive into the stock market and you surf the big waves like this guy was trying to do, there's some things that you need to learn, and there's some things that you need to do. Just like if you're going to learn to surf, you don't start by paddling out on the north shore of Oahu. You have to do a few things first, otherwise you're going to get yourself hurt. Well, for one, you need to learn to swim, right? That's a pretty good start. You literally need to get your feet wet first. You need to be prepared for things to go wrong, and you need to have the skills necessary to survive when things go wrong, so that you know how to handle yourself when the waves do start to crash on you. Well, the same thing goes for the market. While it might not be fun to experience the adversity that happen as you begin to invest, if you prepare properly, you can at least make it survivable and maybe even thrivable. Now, keep in mind, every successful surfer, they didn't start out on the shore. They started out on small waves, probably on a board bigger than they were. And they started by learning how to swim and learning how to hold themselves in the water in the small waves. And they eventually built themselves up to be able to handle bigger and bigger things. Well, the same is true if you're looking to invest in the stock market, if you're looking to buy stocks. In this case, you need to learn how to save before you learn how to invest. Otherwise, just if you don't know how to swim and you start jumping in the water, it's not going to go well. In life, just like in surfing, there's going to be waves that crash on you. Even if you do everything right, it's a guarantee that there will be storms. When I was growing up, they always told me to save my money for a rainy day, and they never really explained what that meant. I always thought that it meant, well, when it's raining outside, I can't go play basketball, I can't go play baseball, so I better have some toys and games to play with to save my money for that. Well, that's not really what it means at all. It means saving up for the inevitable storms that are going to come into your life. That's why the first step to buying stock is actually saving cash, and it's to save up money in a rainy day fund or an emergency fund. I love this quote from author Jane Bryant Quinn. It says, the shortest period of time lies between the minute you put some money away for a rainy day and the unexpected arrival of rain. I think that's a lot of us could probably relate to that. And so again, your first financial goal should be to build an emergency cash reserve or a rainy day fund. One thing we know is that life is going to throw us curveballs, and usually those are expensive curveballs. If you have a good solid cash reserve of 3 to 6 months set aside, you can turn those curveballs into an inconvenience instead of devastation. It prevents you from having to dig yourself into a hole, to go into debt, to borrow money. And when you dig yourself it can be very hard to get yourself out of that hole. So think about, what would you do if something goes wrong in your life? What if you're in a bind and you need money? What would you do? And if the answer to that question is, well, I'd beg, borrow, or steal, well, that means that your first financial goal needs to be a cash reserve. There can be a temptation when folks ask me, hey, what stock should I buy? What should I be looking at now? I always ask, well, what's your rainy day fund look like? Because a lot of times folks, they see the stock market as a way to get themselves out of financial tightness. And if anything, if that's your approach, it's like, well, if I can make some money on this stock, then maybe that'll help loosen things up for me. That's a dangerous behavior, and you're more likely to get yourself stuck in a position where you have to pull that money out when your stock is down and when life tells you you need that money instead of being able to keep your head in the game and like you need to be a good investor. And I'll talk a little bit more about that. But basically, you have little business investing towards long-term goals if you haven't taken care of your short-term needs. And so my most important rule in investing that I always come back to is don't use long-term investments for short-term goals. You see, stocks are long-term investments. They need time to cook. I tell folks that the minimum time horizon you should really have is at least 5 years, but longer is better. And that might seem like a long time, but we just don't know when the market winds are going to go against us. And it might take longer than you think to come back from something. And so the longer you have, the better. But most importantly is just to keep that frame of mind that, all right, these are long-term investments that I'm not going to have to touch for a while. If you haven't set aside enough cash for when the inevitable things go wrong in life, it can make you a bad investor out of no fault of your own. Here's why. If you haven't addressed your short-term needs and goals, then you may have to sell those stocks and bonds at a bad time to address that emergency situation. And you can't deal with those situations and keep your long-term investment. If you can't keep your long-term investments in place through the sell-off, then you're just not going to be prepared for those curveballs. So it's important to have that reserve set aside, and you keep yourself in a better mental state if you can say, well, I don't need this money for 5 or 10 years. I'm going to be okay. I've got other resources. And so it's not always easy, and certainly it's usually not easy, but you got to find a way to budget yourself so that you can learn to save cash. So speaking of cash, there's 3 main asset classes that we tend to think about when it comes to saving money. And they're, cash is cash, bonds are loans, and then stocks are ownership. And so Cash, it's its job to be there when you need it and to be the same amount that you put in. Bonds, if you're not familiar, bonds are a loan to whatever entity is issuing the bond, whether it be the federal government for Treasury, U.S. Treasury bonds, or corporate bonds that you're loaning money to that company. Otherwise, there's even municipal bonds where you're loaning money to your state and local government. But stocks, you're an owner. If you are someone who is interested or looks at real estate as an investment, well, that falls into that ownership bucket. And so remember that you are an owner in a business, and you want to look for businesses that you would like to be an owner in. So why do we invest? Why don't we just leave it in cash? Well, quite simply, it's to make more money. There's a famous bank robber that was around before I was born named Willie Sutton. And when they asked him why he robbed banks, he responded, because that's where the money is. And so on that same token, why do we invest? Because that's where the money is. If you aren't familiar with the concept of compound interest or the compounding of returns, it's really where you should start so that you can understand how powerful compound interest can be. It's Albert Einstein, and he has some famous quotes when it comes to compound interest. He said, compound interest is the eighth wonder of the world. Said it's the most powerful force in the universe. He who understands it earns it, and he or she who doesn't pays it. And think about that. He's obviously being a little bit tongue-in-cheek when he says it, because I don't know that you're going to win a war with just compound interest. But once you see how powerful money is when you invest it and it earns a return over time, it really does take on a life of its own. And eventually you can earn as much in interest as you were initially investing. I'm not going to go too terribly deep into it, but think about it. Let me just go through a quick example. So if you have $1,000 and you earn 10%, then that's going to be $100 that you earned. And now you're up to $1,100. The compounding effect is that if you earned another 10%, you're not just earning another $100, you're earning interest on your interest. So 1,100 turns into 1,210 because you earned not just interest on your original 1,000, but on the amount on the interest that you already earned. And so if this is not something that you're familiar with, I'm not going to spend any more time on it, but I'd encourage you to do the website and check out the teachingkidstobuystocks.com and then the /Einstein, and that will take you to our examples on compound interest, and we'll walk you through several examples, and you can see how powerful it can be to start early. And you can also see that we have a compound interest calculator on there as well. But back to stocks, back to what we should think about as we look to figure out maybe what companies we would want to invest in. The best investors historically, they're really good at remembering that stocks are businesses. And quite simply, you want to look for businesses that you wished you owned. Here's a saying that I like to use. It is very simple to know, but easy to forget, that stocks represent real people and real businesses trying to make it in the world. When you start to look at stock charts and ticker symbols and things like that, it can be easy to forget, these are real companies with real people behind them. No different than if you were looking to start a business of your own. You want to look for businesses that represent something you would want to own. Some stocks represent brand new companies that may or may not make it. Some stocks represent companies that have been around since a decade. And then there's 1,000 points in between. But in the end, stocks are businesses, and it's best to not forget that. There's literally thousands of different ways that you can invest in stocks and in bonds. You can buy them directly. For most folks, their main source of owning stocks is through their retirement plans at work, through a 401k or something similar. Now, in those plans, you don't actually buy the stocks individually, but you do it through some sort of fund, usually a mutual fund or something similar. In a mutual fund, it's a way to invest in many stocks and or bonds or both all at once. Your investment's pooled with other investors, and the management company, they purchase the shares on your behalf. One share of a fund may represent dozens or even hundreds of investments inside of it. The shares only trade once a day at the end of the close of the market, but there are actually more mutual funds to choose from than there are actual stocks to choose from, which is rather remarkable and hard to believe. There's also exchange traded funds. You may have heard of ETFs. They're going to act similar to a mutual fund. One of the main differences is that the shares can be traded throughout the day, not just at the end of the day. But there's many types of those as well. And a good way to think about funds versus just buying individual stocks, I always like to use the visual of a window. So, and this helps you understand risk, because when you buy individual companies, the risk is much higher than if you buy a fund, because you're riding that one wave of what that one company does, whether that's good or bad. I mean, it could be very good, but it also can be worse. You tend to see a lot more fluctuations if you're going to own one company versus if you own a basket of companies. But I like to use the visual of the window pane as you see here. So let's imagine you have this big giant window in the front of your house, and you got some kid throwing rocks at your house. Well, if he hits that piece of glass and you have just the one stock, well, you're replacing you're replacing the whole window, you're replacing that whole piece, no matter what. Versus if you have a fund and you have panes of glass, well, maybe he only takes out one pane, so you only have to replace that one small piece of glass. So it just helps you see that, there's a lot less risk. There's still risk, but you don't have quite the fluctuation you do when you buy a fund versus buying an individual stock. Now, I'm not trying to push you one direction or the other, but you just want to understand how much risk you can handle, both emotionally, but also within your own financial situation. You want to make sure you understand how much risk that you can take before it would really hurt your life. You should never invest so much in the market that what happens in the market will cause your life to drastically change for the worse. If you're taking on so much risk that if the market goes down, suddenly you're drastically changing how you're living your life, well, then you're probably taking on too much risk. And be careful of your emotions. Fear and greed are the two biggest factors when it comes to money that push people into bad decisions. Part of why I tell folks to have a rainy day fund first, because it helps you check your emotions if you know that you've got some cash set aside. So don't view the market as some sort of get rich quick. Rather, it's a place to buy assets that you hope will grow over time, but maybe not all the time. And so just understand that most folks that build their wealth by investing in the stock market, it doesn't happen in 1 year. It doesn't happen in 2 years. It happens over time. It happens by just saving in a disciplined manner, month over month over month. And, for most folks in this country, it happens through their retirement plan. And we'll talk a little bit more about that in a bit. But know yourself. And so this is an image of the Greek temple to the god Apollo in the ancient town of Delphi. It has two phrases inscribed upon it. One is know thyself, and the other is nothing to excess. Of course, it's not in English, it's in Greek, but that's how it translates. and translates, and these are ancient Greek principles, and I like to apply them to investing because one, you need to understand how much risk you can tolerate before you're going to lose sleep at night, and make sure that you're not taking on more risk than you can handle. It shouldn't cause undue stress. And the other thing, nothing to excess. It goes back to don't try to get rich overnight by buying stocks, because that's what you're trying to do. You're probably going to be disappointed. You don't need to make big bets. You can start small. Now, if you're just investing, a couple $100, maybe you only make one investment. But as your investments grow, make sure you look to diversify your investments into other assets, other stocks, other funds, if you will. Second, don't make too many changes to your accounts. Don't, what I call, overtrade your stock bonds, trying to catch this wave and sidestep the next one. Just be disciplined and stick to a plan over time. And also, along the lines of nothing to excess, don't obsess over your investments. Again, if you're losing sleep or it's making you overly anxious, maybe reassess how much risk you're taking. And so, with that, let me differentiate between trading and investing. I think that this is really important because when you start to look on Twitter, you start to see people talk about, oh, I bought this, then I sold that. It's important to understand that there is a difference between the two. And a lot of times folks will tell you about their gains, but they don't about their losses. Keep in mind, so trading is more short-term nature. There's day trading where folks are literally buying and selling the same day. There's what's called swing trading, where folks may hold stuff for a few days or a few weeks or even a few months. There's a bunch of different types of trading versus investing, which is more holding things for longer periods of time and taking a more and hold approach. It doesn't mean you don't make changes and that you don't take profits at times, but you're not doing it every week or every month or every day when you're investing. And when you think about these two, think about this. There are millions and millions of people who have built their wealth through investing by not really knowing that much more than the average Jane or average Joe, but just being disciplined about putting money away, buying things they understand, and then leaving it alone for a long time. And there have been studies that show that folks that touch their investments less, they actually tend to do much better over time. Now, that's not to say there aren't folks that do very well by trading. Understand this. Trading is a very highly, highly specialized skill that takes an extraordinary amount of knowledge and research and discipline. And even the folks that have that knowledge, that do the research, and they have that discipline, the overwhelming majority are not successful at doing that over a long period of time compared to folks that just invest and leave it alone. So think about this. You have one group where it's very technical, very highly specialized, and still hard to come out on top, versus the other, investing, where you don't need to be that sophisticated, you don't need to be that educated, you just really need to have some level of discipline and self-control, and has a much higher success rate. So if you are trying to learn trading, I don't want to discourage you, but just understand how the odds are stacked and be prepared for a much, much steeper learning curve. Now, I told you I grew up in rural Kansas, and the folks that made the most money that I knew growing up in the stock market, they weren't slick back hair Wall Street types. They were actually the wives of farmers. And being that this is a women's group on Facebook, y'all should appreciate this. It was these farmers' wives out in the country that when Dad came home and from working on the farm, Mom was sneaking down to the bank and putting a little money in the utility company or putting a little money in that company. And over time, what you found is that those little investments in these companies, they actually did a lot better than the farm businesses, unfortunately. And so that is how I learned from these, what turned in, by the time I was grown, little old ladies that just were disciplined about going in and buying a little bit of stock every so often. So just keep that in mind when you get on Twitter and you hear people talking about trading in and out of things. Now, we're going to talk a little bit about how to find good companies, how to pick companies that will do well for you. There's a almost endless supply of stocks to choose from. In the United States, there's about 4,400 publicly traded companies. There's a lot of companies that aren't publicly traded. And if you see this chart here, you'll notice that the number of companies that are available to buy has actually gone down quite a bit since the mid-90s. It's come up a little bit since the early 2000s, but there's about 4,400 companies in the U.S. to choose from. And not all those companies are good companies, and not all those companies are worthy of your investment. So you want to be picky. In the entire globe, there's actually over 600,000 public companies to choose from. So there's no shortage of stocks to pick from. But we don't just want to pick a stock. We want to pick stocks that go up. We want to pick stocks that are going to make money for us. And there's an old phrase that anyone can pick a stock. A monkey with a dartboard can pick a stock. And there's a legendary story that who knows if it's true or not, but that someone actually did a study to see who did better, the professional stock pickers or the monkey with the dartboard. And legend has it that the monkey won. So keep that in mind when you take opinions from folks. There's more than enough opinions to go around. It doesn't take long to find one. But trust your own instincts, do your own research, find an advisor or somebody that you feel like you can trust that can help you out with it if you don't feel comfortable on your own. But just keep in mind, it's dangerous if you are buying stocks because so-and-so on Twitter or so-and-so on CNBC said to. Make sure that you take ownership in that and that you do your own research and don't just do it because some guy or gal said so. So kind of getting into the meat of things, I like to use these three words to really help you understand what goes into picking a good stock. First off, what's the story? What makes you want to own this business? What are the numbers and how much money are they making? And I'm going to get into that next to help you see how to figure that out. And then maybe most importantly, what should our expectations be for this company and for this stock? And equally important is what are the expectations that everybody else has? What expectations are built into that story and into that numbers? And you always want to be thinking, what happens next? The phrase I like to use is always be looking around the corner. And I'm constantly trying to remind myself, all right, what happens after what just happened? What can I expect things to look like next year or next, 2 years later? You want to think about what are the future prospects for the company. Oftentimes, you may find that something is extremely hot right now, but do you think that it's going to have staying power? And if it does, then maybe you're onto something. You want to know, how do they make their money? Do they make money? And will they be making more or less in a few years? Maybe they're part of a new trend that's going to continue, or maybe it's just a fad. So you want to be thinking about that. You want to think about what other companies might try to copy them, and if so, do you think they can withstand the competition? So you just want to make sure that story is going to last long enough for you to be a long-term investor. And you want to think about, well, what could go right and what could go wrong? So don't try to talk yourself in or out of the investment, but do your best to take an objective view And you may find that that thought process actually reinforces your position that you're onto something good. So I apologize ahead of time. This is where to nerd out just a little bit, to try to make sure to keep things at a level that hopefully everybody can really understand. But I think that this is the part where you can really increase your knowledge of how things work and how people evaluate a company and what goes into that stock price, if you will. So I'm going to pull up a quote from Yahoo Finance. So if you Google Yahoo Finance, it will take you to the finance section of the website. There's any number of other websites that you can use to pull up a stock quote, but I pulled this one from Yahoo because I find it pretty user-friendly. I've been using it really since I was in college, back in the late 90s. But this is Apple. This was a couple of days ago. Apple actually reported their quarterly earnings about an hour ago. I haven't gotten a chance to see how they did, but this was the stock price a couple of days ago. And what I'll have you focus on here are a few things. You see a lot of numbers there. Up at the top, that's just the most recent price, the 278.58. That was the most recent price a couple nights ago when I put this chart together. But I'll draw your attention to a few things. You see days range and the 52-week range. As you might guess, that's what the stock price was traded at over that particular day. You saw that it bounced between 278.20 and 285.83. And over the last year, 52 weeks, it's had a pretty big range in there. It's bounced between $170 a share and $327 a share. So, if you bought that stock towards the low end of the range there, you've made some money. But if you bought it up at the high end of the range, you're still waiting to try to get back. And I won't explain all these numbers, but I'll show you the ones that I think are most important for you to know about. So market cap, that's a really nerdy way of saying what's the whole company worth? What's the entire company worth? So let's say you own a restaurant and you're looking to sell that restaurant to somebody else. Well, whatever that price is, whatever price you guys agree on or gals agree on, that would be the market cap for your restaurant. Well, same thing here. If you take all the shares of Apple and you multiply it by the stock price, that gives you the value of the whole company, which is known as the market cap. And so you can see that Apple is worth about 1.2 trillion with a T dollars, which is obviously quite a lot of apples there. But if you didn't know what that meant, that's what it means. The next thing I'll show you is what's called the forward dividend and the yield. So that's telling you how much of the company's profits are they paying out in cash. It's not their actual profits. It's just the portion of their profits that they're paying out in cash. For Apple, they pay over the course of a year. Now they do it quarterly, but over the course of the year, they pay out $3.08 in a cash dividend for every one share. So if you own one share of Apple in a year, you should expect to have about $3 in cash in the account, which equates to about a 1% yield if you want to compare it to like a savings account or something like that. If you run $3.08 divided by 278.58, it should come out to 1.09%. And so keep that in mind, 1% on Apple. Again, dividends are the cash paid from a company to shareholders. The dividend yield is the dividend divided by the share price. Next is probably the most important number or the most important thing in picking stocks. It's earnings or earnings per share. Another way to think about this is the company profits. And to come up with the earnings per share, it just takes that total number of the company's earnings and divides by the number of shares. Similar to how the market cap is simply you divide the market cap by the stock price, it gives you the number of shares. It's the same thing. It helps you understand, all right, how much are they making per one share that I own in profit? I have a phrase that I like to use. It's that stocks follow earnings. And if you're looking for companies that are going to see their stock price go up, really what you're looking for are companies that will see their earnings go up, because the stock prices tend to follow the path of earnings or the profit. That makes sense. If you have a restaurant and sales are good and they keep growing and growing and growing, and you keep opening new ones, your company is worth more. But if you have a restaurant and sales keep going down and you have to, maybe you had 10 restaurants and you had to close half of them, well, your whole company, it's worth less over time. Well, same thing with stocks. Stocks are going to follow the earnings. I'm going to show you another company, and I'm not recommending these companies. I'm just using them as examples. This is not advice. This is just education. But I want to help you understand how different companies might fit different goals for investors, and just give you a chance to compare and contrast some things. So we talked about Apple. We'll keep it in the A's, and we'll talk about AT&T. Sure, we've all heard of AT&T. Been around longer than Apple. Been around for longer than me. But notice here I highlighted the dividends again. And for AT&T, you'll see that it is about $30.65 a share as of a couple days ago when I put this together. That equates to a much higher yield than on Apple. Notice that $2.08 divided by 30.65, that gives you 6.81%. So if you own one share of AT&T, you hold it for a year, you can expect to have $2 in your account. Remember, you needed to buy one share of, you had to buy a share of Apple at over $270 to get about $3, if you recall, $3.08. So you get a lot more cash return from an AT&T, but also notice that the chart to the right side there, that chart actually is the stock price of the company for the last 5 years. And notice that it's about where it was 5 years ago. If you bought it at one of those high points, then you've lost money. If you bought it somewhere at the low points, you've barely made any money. But you've earned that yield over that period of time. And they've had a tendency to increase their dividend every year. They've actually increased their dividend every year for 36 straight years, which is pretty remarkable. But compare that to Apple, you may not be getting as much cash, but if you bought that stock down at $130 or even less than that, you've made more than enough to offset the fact that they don't pay you much in cash. So it's just two different types of investments, both stocks, both big companies that most everybody's heard of, but one, you expect your return to come more in the form of cash. The other is come more in the form of capital appreciation, or other words, the stock price going up. So let's unpack that a little bit. Why is that the case? Oops. Sorry, guys. This is what I wanted to show you. Sorry about jumping around there. If you're on Yahoo Finance, you can go to Financials, and you can find a spot that will show you the earnings per share, and you can find the estimates for the growth of those earnings per share. And so this is AT&T, and notice that where I've highlighted, they're expected to grow their earnings at about 4%. These are from the analyst communities that have put together their projections for how the company is doing, and they're expecting earnings to grow about 4% next year, and less than that, 3.7% over the next 5 years. You'll see the bottom thing highlighted is the past 5 years. Notice that they've actually grown their earnings at about 9% over the last 5 years. Compare that to Apple. Same thing, you go to Financials and you go down to the bottom, I believe it is. you'll find the growth estimates for their earnings per share. And see, Apple's expected to grow their earnings at about 20.9% next year, and over the next 5 years at about 12.5%, a little over 12.5%. Over the previous 5 years, they've grown them at about 8.5%. And so part of the reason you saw their stock price go up so much is, one, they've had good earnings growth over that time. You can see it's been just a little bit higher than what AT&T's has been, but they're projected to be able to grow their earnings by quite a bit more than AT&T. And so that's why even though the stock doesn't pay as good as a dividend, it's performed quite a bit better because folks expect those earnings to go up by a much higher rate. And again, a lot of what factors into how stock prices perform is what those expectations are. Now, if expectations aren't met, that's when stock prices get hit pretty hard. A lot of times you'll see a company that they report their quarterly earnings and maybe they beat the number everybody thought that they were supposed to get, but they said, yeah, we hit our number for this quarter, but we have to ratchet down the expectations for next quarter or for next year. They might have beat their number, but the stock price still goes down because they changed the expectations on what the future growth is, because the market is almost always looking forward and almost always trying to figure out, what's going to happen next. Sorry, jumping around here a little again. Oops. Okay, so sorry about the jumping around. Hopefully I didn't make anybody seasick. One more ratio, and then I will pull us out of these numbers before they make us too weird here. But it can be hard to compare earnings per share of one company versus the next. It certainly helps when you looked at the growth numbers like we did. But my favorite ratio, if you will, earnings are my favorite thing to track because that gives you the path of the stock price over long term. But it can be hard to really evaluate, what's a good earnings per share versus another one when the stock prices are so different. And so the PE ratio, PE stands for price divided by earnings. And what that means is, it's quite simply, the arithmetic's simple enough. It's the stock price divided by the earnings per share, and it gives you this factor. So you'll see for Apple, it gives you a factor of 22. The way I like to think about that is, in essence, it tells you how many years worth of this year's earnings are represented in that stock price. Because if you take 12.6, the earnings per share of Apple, and you multiply that times 22, it gives you the stock price. Let's go back to the restaurant analogy. If you have a restaurant and you're selling it to another person, they're going to ask you, well, what are your sales and what are your profits? And then they're typically going to try to think about, well, I wonder what those are going to be next year and the year after. But they're going to take that number and they're going to multiply it by a factor or a multiple, if you will. They may say, you know what, if you are making $50,000 in profits, I'll give you $200,000 for your business, which that would have been a factor of 4. 50,000 times 4, 200,000. Well, it's the same thing when you're looking at stocks. You're deciding whether it's, what am I willing to pay for what the earnings are now? If I expect those earnings are going to go higher, then maybe I'll pay a little bit higher factor. But if I think those earnings are going to stay the same forever or go down, then I'm not going to pay as high a factor, because I want, you want your investment to, you want to eventually get paid back for that investment. Now, keep in mind, that's not the same thing as the cash. You don't get those earnings in your pocket. You only get what the dividend is. But when you're the owner of the company, you leave those earnings in the business. You leave those profits in the business. Well, the same thing with the stock. Those earnings represent the profits, that are made by the company, and the dividend is just what is paid out in cash. But that PE ratio, it gives you a good way of evaluating what the market thinks of this company. Does it think that it's expensive or cheap or worth paying a higher price for? And it's a factor of the earnings. So let's compare that to AT&T. If you do the same math on AT&T, you take the stock price divided by the earnings, it gives you a PE ratio of 15.6, which means you're paying for about 15 and a half years worth of this year's earnings all at once. So it's relatively cheaper as a stock than Apple. Now, cheaper isn't always better because, as you saw, AT&T is not expected to grow their earnings as much as Apple. And so folks aren't willing to pay as much for that stock because it's not going to give you as much earnings growth. That being said, it does pay you quite a bit more in cash. So these are the things that stock analysts and investors look at when they're trying to determine, is this stock expensive? Is this stock cheap? It shouldn't be the only thing you go on. You shouldn't just say, hey, I only buy PE stocks with low PE, because that PE reflects expectations. If something has a low PE, the investment community is not really expecting much from that earnings growth. So you don't want to use any one thing to push you into your decision, but it's multiple factors all stacked up. Maybe you look at what that PE has been over time, and you can do that as well. But just wanted to help you understand what some of these numbers mean, so that when you're comparing things, it gives you some insight. So one more before, like I promised, we'll get out of the numbers before we get too weird. Netflix, we've all heard of Netflix, especially the last couple months. Notice here, the stock price individually is at about $400, $403.83 as of a couple days ago. You see right next to that, that's negative 17.55. Well, that was the return for that particular day. It meant that the stock was down $17.55 from the previous day. You can back that up where it says days range, and you'll notice that the range for that particular day, I believe this would have been on Tuesday, was between $402.91 and $421. But what I really want you to focus on is where I've highlighted in yellow, the earnings per share for Netflix for the last year has been $4.94. So if you take 403.83 divided by 4.94, it should give you 81.73, which is the PE ratio for Netflix. So when you're buying Netflix, you're paying for 81 years worth of this year's earnings, which you might think, gosh, that's a lot of years to get back before I'm made whole. Why would anybody pay 80 times the earnings for that stock? And the reason is they've grown their earnings by a tremendous amount over the last 5+ years. They've gone from negative earnings to $4.94 in the last, I believe, like 4 years. They've grown their earnings. I thought I had it in here. I must have left it out. They've grown their earnings by about 50% a year for 5 straight years, which is remarkable. And so when you're modeling things, if you're modeling things out, if you're looking at 50% earnings growth, then that 5 would turn into 750 in a year. They're actually not projected to grow at 50% next year. They're projected to grow at about 30%, which would be about $6.50 next year. But you can see that if you keep growing your earnings at 20, 30, 40, 50% year over year, that's how folks justify paying a little bit more in a PE ratio for a company like Netflix, because it's all about the expectations for those numbers. For the expectation, if the expectations are for them to grow at a very high rate, folks will pay for that growth. And we've seen Netflix grow from basically a DVD by mail company to a company that others are mimicking and trying to catch up to. You see Disney Plus and what they've done. They're doing that to compete with Netflix and any other number of companies that try to compete with that model. Kind of an interesting side note on Netflix and how branding and marketing can play such a role in how a company progresses. When they decided to call it Netflix, the name that took second place in the decision was DVDbymail.com. So it makes you wonder if would they have had the path that they had if they were still called DVDbymail.com. I'm sure they'd have had to make a name change along the way as a lot of us saw that business model shift from DVD by mail into a streaming service. So to recap a little bit here, stocks follow earnings. I've probably beat that horse till it died twice, but the idea is that you want to find companies that are growing their earnings, or stocks follow dividends. Find companies that are growing their dividends. And again, it's the story, the numbers, and the expectations, but most important is the direction of the story, the direction of those numbers, and the direction of the expectations. Because if the expectations are too high, and maybe they do keep growing, but not at the rate of what expectations were, then maybe that stock price will suffer because the expectations were too high. So obviously with the Netflix, there's very high expectations for them to continue to grow at a very high rate. And if they fail to grow at a very high rate, the stock price is going to reflect that. Then one more thing. Stocks don't just follow earnings and dividends. Stocks follow the market. And day to day, day in, day out, more than anything, if you own a company's stock, you'll notice that if the market's up, your stock is up. If the market's down, your stock is down. Maybe not every time, but by and large, the thing that pushes stocks up or down in the short term is just what the broad basket of companies, what the broad market is doing. And so if you own a company, you want to be very mindful of that. Why is my company's stock down? Is it because something changed within my company? Or is it just because, the president tweeted something, or, something else that really doesn't impact your company? You want to make sure that you're not just reacting to the whole market pushing you around. Because day in, day out over the short term, it can be hard to determine whether it's your company or whether it's the market. Over time, you'll start to see, all right, maybe the market's doing better than my company, or maybe my company's doing better than the market. But in the short term, stocks tend to just follow whatever the other stock is doing. So if you're looking for how or where to actually buy stocks or buy a fund, there are so many places that you can do it. I threw four of them up here for you, not to recommend them, just to give as examples. You can actually buy stocks for free, no commissions at all of these places. Now, I'm not suggesting that you do that. You may find that that's good for you, that you're comfortable picking them on your own. But a lot of folks will choose to work through a financial advisor, and financial advisors do not work for free, but they also will give you advice, and they'll help you determine what's appropriate for your situation, and they'll help teach you things. But if you want to do it for free, you can do it. This is new relatively. In September of last year is when 3 out of these 4 services went to free commissions on most stock trades and a lot of fund trades. Robinhood really started that, and then others have followed suit. But free is not always better, because there's definitely can be value to having a financial professional help you figure out what's best for you and to give you some insight. But just want to make you aware that it doesn't have to cost money. But if you do decide to work with a financial advisor, what I'd recommend that you do, try to get a reference or referral from somebody that you know and trust that can vouch for that person. Just like, pardon me, just like not all companies are created equal, not all financial advisors are created equal, and not all of them are good at what they do. But that's why I recommend that you try to find somebody that you know, that you trust, and that someone else you know knows and trusts that person. So retirement, this is one of the most misunderstood concepts around investing is do with retirement plans. A lot of companies, many companies, offer 401k plans or similar. Or if you work for the government, you may have a 403 or another type. And if you do, you may even get a match on your contributions, meaning if you contribute 3%, they'll match 3%, or maybe it'll be if you contribute 8%, they'll match half of that. If you do nothing else, make sure to try to contribute everything you can to get all of the matching contributions that you can. Don't forego saving into your rainy day fund. Figure out a way to budget to do that, but try to really do both your rainy day fund and contribute enough to get that match. So that's free money, and you would just be absolutely amazed at how quickly you can accumulate a nice nest egg just by, one, contributing every pay period to that plan, but by also getting a match on that. It's really, in my experience working with folks, that's how a lot of folks have been able to accumulate really nice nest eggs and accumulate some wealth, is just by contributing to get all of the match that they can on their retirement plan. So first, I just wanted to give you that advice, or education, not advice. If you're looking to save regularly beyond your retirement plan or 401k, you also might have the option of opening your own IRA, individual retirement account, or Roth IRA, where you can buy stocks, bonds, funds. You can buy pretty much any other investment underneath the umbrella of that Roth IRA or IRA. Let me talk to you a little bit about the difference between traditional IRAs and Roth IRAs, and this would also apply to traditional 401ks versus a Roth 401k. Now, keep in mind the R stands for retirement. So if this is money you're planning on using in the next 5 years, then that may or may not be appropriate, because the retirement plans, they will want you to keep that money in the account until you're at least age 59 and a half. If you take money out of a traditional plan before 59 and a half, there is a 10% penalty. But the difference in the two is when the money is taxed. So with a Roth plan, you're putting in after-tax dollars. You don't get a tax deduction for the money going in. On a traditional plan, a traditional 401k or traditional IRA, you typically get a tax deduction on the amount that you put in. Both types of accounts will grow the money without paying taxes year to year, because if you're not inside of a tax shelter such as this, if you just own them in a joint account or an individual account, then you have to pay taxes on the dividends you receive. If you buy something at 100 and sell it at 150, you have to pay capital gains taxes, either short-term or long-term, on that gain that you made. But if you do it inside of a retirement plan, you don't have to pay those year-to-year taxes on dividends and capital gains. Now, on a traditional plan, whether it be 401k or IRA, because you got the deduction when the money went in, you have to pay taxes when you pull it out, and it's ordinary income tax. So if you put in, $10,000 pre-tax, and then you let it grow and you start pulling out $50,000 in retirement, you're paying taxes on that $51,000. So keep in mind, when the money starts to come out, it's taxable in a traditional plan. And if you do it before you're 59 and a half, then you have a 10% penalty for the most part. There are exceptions. Now, with a Roth plan, you don't get that tax deduction going in. You don't pay the taxes year to year, but when you pull out money from a Roth IRA or a Roth 401k, you don't pay taxes. It grows and then it comes out tax-free. And so you didn't get the upfront deduction, but you don't pay taxes on any of that growth when you pull it out. In addition, on a Roth plan, you may be able to access the contributions that you put in before 59 and a half without a penalty, which can come in handy as well. So not the growth, but the contributions you may be able to pull out before you're 59 and a half without paying penalties. So something to keep in mind. Don't want to dive too further into the rabbit hole, but just understand that the reason there's a picture of umbrellas on there is because the retirement plan just represents the tax shelter. It protects you from the rain of taxes, but you can put any investment underneath that umbrella. If it's a company plan, then you're going to be restricted to whatever funds are available in your company plan. But once you're in an IRA, you can buy the same stock in a Roth IRA as you would in your individual or joint account. The only difference is that umbrella to protect you from the taxes. So hopefully I didn't confuse you too much. As always, make sure that you do talk to your tax professional, you talk to your financial advisor to make sure that you aren't making mistakes how you set it up. But just know that you have some options, that you don't just have to put it into an individual account and pay taxes on it. So let's pivot to talking to kids. That's why there's a picture of a kid up there. This is actually the kind of the heart of my book. I do cover all the things that we've covered so far in the book, but the goal in writing the book was to help you, no matter what your education level, have a way to talk to your kids about money and talk to your kids about investing. So the first thing that I recommend is to talk to them about money as early as you can. As soon as they're old enough to stop putting the coins in their mouth, it's a pretty good time to start talking to them about the value of money and how much things cost, and start to have that conversation. You have an allowance for them so that they can learn to handle their own money. Once kids start to realize that they can trade those coins that they used to put in their mouth, that they can trade that for candy and toys, they tend to want to do that pretty quickly. And so with my kids, when I noticed that happening, I challenged them to save their money. We actually came up with what was called the $500 challenge, where when they were, I believe, about 4, 5, and 6 or thereabouts, we challenged them to stop spending their birthday money and their holiday money and their allowance money. But we said, if you can save up $500, we will match it. Now, it turned into a bit of a bait and switch, because what we didn't tell them initially, but we eventually told them, was that we're just going to give them $500 to go blow on whatever, but they're going to need to take that $500 and use it to buy stocks with. And that's how we got them started. But it was a great experience, because them to wanting to save because they wanted to reach that goal. The other thing is we talked to them about the businesses that we were at. You know, if we were in line at Chipotle waiting for a burrito, then we talked to them about, wow, this place is doing pretty good business. So, you know, talk to your kids about the businesses that you shop at, the businesses you see, and talk to them about how that company makes money, and have them start to think about looking through the world through the eyes of a business owner. Eventually, you can start to have the conversation that, well, you know, some of these companies are what we call publicly traded, and some of them are just private businesses. And those publicly traded ones, that means that anybody that has money enough to buy shares, they can actually become partial owners in that business, and start to talk to them about, well, what businesses do you see that you think might be good investments. It doesn't mean you have to invest in that business, but it's just good for them to start to understand how these things work. With my kids, when they started to spend their money and we started to have these conversations, you know, one of the places that they loved to go to when they were little was Toys R Us. You know, they'd love to go check out all the new stuff. You could play with this stuff. It was a pretty cool place to go. You know, the old phrase was where a kid can be a kid. And they loved that place. And then they started to understand the value of money, and they started to spend their own money, and their love faded a little bit because they discovered that their $25 didn't quite go as far at Toys R Us as it did at other places. They found, wow, I can get a few more things if I go to Target or Walmart. They were not that surprised when they saw that Toys R Us ended up filing for bankruptcy and going out of business, because their experience was, well, it just wasn't quite as good a deal. Now, that's not suggesting that price is the only thing that matters, because we try to teach them to support our local businesses and to sometimes pay a little bit more, because we want to see our local businesses survive and thrive. But it's good to have that conversation about how we vote with our dollars. To them, they didn't feel like there was much difference between going to a Target or a Walmart versus a Toys R Us other than the price. If we were going to our local downtown toy store that's owned by, you see the owner there and you have a different type of loyalty, you know, maybe in that situation they're happier to pay a little bit extra for that, because it keeps it in our downtown and it keeps the dollars local. So it's just good to have those conversations with kids about business, and you don't have to wait till they're teenagers. We were having these conversations when they were quite young. We touched on this, you know, public versus private. Make sure you help explain that. And then something else that we did that was a lot of fun and we continue to do is you have a stock picking contest. This is something that we do every year, where everybody in the family picks 2 stocks, and we don't put real money in it. We just keep track on paper, but we go from one year to the next. We see, all right, whose stock did the best over this last year. And it helps, you know, there's nothing wrong with tracking stuff on paper and investing on paper instead of with real money, because that it helps you learn. That's definitely how I've learned a lot, is by tracking stuff on paper, tracking ideas, and then eventually you put real money into it when you feel comfortable. So I've talked to you for a long time. We've covered a lot of things. One more time, I'll show you the website and the social media. And again, that's my phone number. You're welcome to call me or text me. Just happy to help in any way I can. And that's my email address as well. A reminder that this is education only. This is not advice, in case any of the lawyers out there want to get after me. But I really appreciate Dr. Leaf having me on. I'm going to attempt to take it off of the slideshow. Hey, I'm back. I think I grabbed my hair in the process. So if there's any questions I see in the chat, nope, I don't see anything. So, well, again, thanks so much, Dr. Leaf, for having me. I hope that this was educational for everybody, and that my wife's laughing at my hair right now. If you do have questions, feel free to reach out, and wish everybody the best of luck and best of health. Thank you so much. Graceland, you can go ahead and ask your question. I didn't shut it off yet. So that's a good question. Graceland asked, how do you see the stock market recovering due to COVID-19? I'd say that's the $1 million question right now that a lot of folks are asking. and I'm not going to tell you anything you don't know. It's definitely uncertain right now because the earnings picture is so hard to see. I've been unbelievably impressed with the bounce that you've seen in the market off of the bottoms that we saw in March. It's been, you've seen the market come up quite a bit from when we saw such panic just a month ago. And really, it's so hard to tell that a lot of folks feel maybe there's some sort of disconnect because you've seen the market do pretty good, but then the economy still continues to suffer. And so what I would say is I think that in the short term, it's almost a guessing game, and anybody that tells you that they have confidence what's going to happen next, they're guessing just like I would be guessing. But I feel like we will, if you can look a year out, 2 years out, I feel like we will get to a place of recovery that might surprise people because you've seen quite a reaction from the government in terms of trying to limit the amount of pain. I mean, it's not been perfect. I mean, I can be critical as anybody, but there have been a lot of programs put in place very quickly that have helped hopefully soften the blow for a lot of companies and individuals. For example, unemployment benefits have been better than they have been in previous crises. You've seen a quicker reaction. And so I feel like a lot of the doomsday stuff you hear people talking about from the economy, it's out there. The unemployment is high. I mean, we've blown through every level on unemployment like we've never seen. But a lot of those folks that are unemployed, I feel like there's a little bit more of a safety net than there has been in previous times. That being said, I'm not going to be surprised if we see the market start to sell off again here as we get into the summer. And I think that your expectations should be that it's going to swing around quite a bit over the coming 3, 4, 5, 6 months until we know what we're pricing from an earnings perspective. So a little bit long-winded way of saying I don't know, but nobody does know. And so I would just make my expectations be that if I'm buying today, there's a really good chance that the market drops underneath that. But I feel like if you keep that long range time horizon, I feel like if you look 5 years out, 3 years out, I think that we recover. I think that we will put people back to work. I feel like there is a lot of built up, support for people wanting to get out and try to support businesses and try to get things back to the way they were. Obviously, try to do it in as safe a manner as we can. But one thing that I see coming is a renewed sense of wanting to support this country. And maybe a lot of the jobs that we've lost over the last 20 years, 30 years, I see a lot of those coming back. For example, I don't think you'll see as much of a rush to push all your manufacturing to China or to Vietnam, other locations where it's cheaper. I think that you'll see a little bit of a renewed sense of bringing some manufacturing back. I think we'll start making our own medicines again. And that companies have maybe learned that it can be inefficient to have your production all over the globe. And that's my hope, is that we start to see some unity in our country, at least around the idea of bringing some jobs back to this country, because as we all know, the politics are just insane right now. And I think that as long as we shut the TV cameras off, we could probably get most Americans to agree that it would be a good thing to start to bring a lot of those jobs that have left the country back to the country, back into this country. And that could be what really gives us recovery that the folks aren't seeing. So again, that's a really long way of saying I don't know. Another question is, what advice can you give to a young adult 20 to get started in the stock market if you don't have a large starting amount? Hey, that's another good question. Great one. Thanks for asking that. I would say, first off, build up your cash reserve. Try to save for into that rainy day fund so that if something goes wrong, you're prepared for that. But then just start small. I'd maybe consider looking, if it's money that you are going to leave alone for a while, look at opening a Roth IRA. If that makes sense for you. If it's saving for a more short-term goal, like a down payment on a house, then maybe that's not appropriate. But don't feel like you have to have, $5,000 or $10,000 to get started. You can open up an account and you can literally invest $100 or $200, but just get into the discipline of doing it. Do a little bit each month, a little bit each month, a little bit each month, and next thing you know, you'll have more than you thought you could save. So just start with a small goal. If you have, if you only have $100, then make your goal to save 1,000. If you have 1,000, make your goal to save 2,000. But just set goals in a time frame that you can meet, and don't feel like you have to put everything into one thing. I'll hang out for a minute, see if any other questions come through. I'm not seeing anything in the chat just yet. So with that, going once, going twice. Well, once again, I really appreciate Dr. Leaf having me on. I appreciate the questions and folks that have tuned in. And again, if there's anything I can do to help, please do reach out. So thanks so much. Oh. Brooke has a question. So the question is there any way to purchase stocks from international companies? It depends. So some companies, even international companies, they will list stocks here in the U.S. So you can, if they do, they'll have a U.S. Ticker symbol that you can use. It's called an ADR, which is American Depository Receipt. So some companies, yes, if they choose to also list here, but not all companies. Some companies you would have to open up a foreign account an account on a foreign exchange to do that. So it really just depends on the companies, but a lot of them you can purchase here. For example, Volkswagen, it's a German company, you can buy here. Nintendo, a Japanese company, you can buy here. But it's just company by company. A lot of the Chinese companies, they actually list on the New York Stock Exchange first. So really, it just depends on the company you're looking for. What's really easy to do, if you have a question, if there's a company, oh man, I want to buy this one, but it's a European company, is just Google, can I buy Nintendo in the U.S.? And you'll actually find the answers. So and through Ameritrade or most of the platforms. I don't want to say any other platform, but most platforms should allow you to do that. Anyone else? Got one more question coming in. Well, I really did a number on my hair, but when that technology didn't work. That's a really good question from your dad. How often should you check your stock to keep you from being on an emotional roller coaster? I guess it depends on how much it affects you. If you're able to not internalize it and not going to make you have bad behavior where you're always freaking out, where you're always wanting to sell stuff quickly, then maybe you can check it more often. But if it affects you and it forces you into bad decisions, then maybe you only check it once a month or maybe once a quarter. I would say you want to get in the habit of checking things, at least once a month or so. But just try to train yourself not to always, just because you checked it means you have to do something. And it really is going to depend on how you can tolerate that. But you almost bring up a good point just with the question, is that the more often you look at stuff, especially, when we can check it on our phones, when it's right there. When I was growing up, I had to wait for the newspaper to come out to find out what my stock did the previous day, or I could call this phone number where you could check it through an automated system. And it probably protected us from being quite as emotional as now when we can look at it all day long. So if you feel like it's affecting you, then maybe you only check it, once a month, or even maybe less frequently than that. At the same time, you don't want to just, in my opinion, completely ignore things. You want to try to understand where you're at, what financial position you're in. But what I'll also tell you is that, use my mom as an example. When I first started helping her with things, my advice was to, when she kept worrying about this and that, my advice was to, stop looking so much. And I remember I went home to visit, and there was a stack of about 17 or 18 unopened statements sitting in her bill box or in her mail, where she keeps all her bills and stuff. She literally took the advice so to heart that she hadn't opened a statement for almost 2 years. And so it actually helped her not focus on it quite as much. And so if you're working with a professional and you have somebody that is watching things for you, then maybe you can look at it even less frequently. So hopefully that helps a little bit. Thank you, Grayson. I appreciate that. It says, appreciate the time and pray blessings over your family. And I absolutely, the same to you guys. Pray for you and hope that you have nothing but success and nothing but blessings in your life. Another question. I see the book going across the screen. Is there a specific book you recommend to read more in depth about this topic? Yeah, I do. If you want to go deeper, then my book will scratch the surface for you. But I have it right here. My favorite book to kind of take things to the next level is actually this one. And William O'Neill is one of my heroes of investing, and he is the founder of Investors Business Daily, which is a newspaper that comes out every day. The website for them is investors.com. But this is his book that I think it first came out in the 80s and then has been revised and revised. This particular one is the 4th edition, but they have an incredibly good community on Twitter. They have some really good videos on YouTube, and on their website, investors.com, there's some good videos. But it will, to me, that's the next level to go to if you really want to start to get into this a little bit deeper. Mr. O'Neill, he is not someone you hear talked about all that frequently. People tend to talk about Warren Buffett and other folks, but I'm a huge fan of William O'Neill, and I've learned so much from his books, but then even more from the folks that he has taught. And some of the most gracious folks on Twitter in the investment community come out of the investors.com family. So yeah, that's by far my favorite one. And it's deeper. You're going to have to read it a few times. It's going to, you have to look some things up. At least I do, because it is a little bit deeper, but it's my favorite one. So really good question. So I think that might be it. Of course, every time I say that, we get another question, which is fine. Well, thanks again, everybody. Sorry about the technical difficulties at the beginning. Glad that we were able to get through that. And if there's any other questions, feel more than free to reach out to me. I appreciate it so much.